A new COVID variant triggers a Thanksgiving massacre in risk assets as European stocks and oil get pummeled. US yield curves price out one hike as Powell's tone turns more dovish and volatility is back with headline risk intensified. All this and more in this week's Macro Insight. Last week, obviously, no prizes for knowing that it was all about the latest COVID variant, which has now been named Omicron. I believe that's how we pronounce it. Obviously, first identified in South Africa. They've basically rang the bell on this one, triggered travel bans in an attempt to contain the spread. And that news triggered a massive sell-off across all the risk asset spectrum as we were in Thanksgiving holidays in the US. So arguably exacerbating the volatility, as sometimes can happen when we have illiquid holiday periods. Now, if we look at across the assets, what's been hit the hardest? European stocks, oil down 2 to 3 standard deviations. High yield credit spreads also ripping higher in both the US and Europe. But they had started to move the week before. So we had flagged a few things that were showing some warning flags, and high yield credit was definitely one of them. I thought it was, on the back of potentially the fact that we've got tapering coming and things like that. It was starting to be a less supported market as risks were rising. But obviously this was just kind of out of left field and it took all the risk assets down with it. Now, if we look at some of those warning signs that we talked about in the volatility market, we had flagged some risks coming out of the volatility space, saying that equity vol had kind of been lagging across compared to other cross-asset volatilities. Well, we certainly got our spike. So we got the V stocks and the VIX and the top left chart there. Obviously, this was more of a European panic than in the US. So you're seeing the V stocks there spiking the most, but they kind of they track each other pretty well and kind of move in tandem. Then you had obviously the VIX spike kind of starting to catch up towards the MOVE index, which is the rates volatility. Still a ways to go if you kind of compare it over a long-term chart, but, heading in that direction. You had the Russell pop in vol, the RVX index. That got to close to 40, which is a pretty elevated level of vol, right? Obviously, the thing was down 5% last week, so you can see why. But what's interesting is if you look at the chart on the bottom right, which shows you the skews and where the skews were pricing, right? And for those who don't know what skews are, it's the 25 delta put versus the 25 delta call. So out of the money puts versus out of the money calls. You look at the volatility differential between those options to give you a sense for how much people are willing to pay for protection. And then this has also normalized that by the level of the vol, which is sometimes what people look at. And then they've checked the 3-year percentiles, 5, 25, 50, 75, and 95 percentiles to plot across all the major indices where these skews were. And Russell skew was flagging extremely low on that basis. It was like below the 5th percentile on a 3-year look back, which is quite surprising. If you look at what was expensive, Eurostock skew was more on the expensive side. But I found that quite interesting that given we were starting to see signs in Europe with COVID, the fact that the Russell being that sort of more cyclical index that was going to get hit by that type of news flow, the fact that skew was so cheap there, I found that quite interesting, right? So you can see here, you had kind of by December next year, you had close to 3 hikes being priced. That's now looking at only 2. By September, we've got 1.25, and by June, we've got 0.6 of a hike, right? So that kind of shows you the repricing from this. And then you had Powell actually talk yesterday, and he was kind of making some dovish noises, which kind of helped confirm that, right? So you see the box where it's got Powell, that was after Powell's comments. So obviously we know that the Fed these days is very quick to react to these type of things and is always going to be, responding on the slightly more dovish side if they need to support markets, right? And that's the confirmation we got. And that kind of helped move the rate expectations yesterday or keep them where they were. Now, equity markets obviously bounced back pretty violently yesterday, but they are going to remain volatile as can be seen today. Let me just bring up the S&P. So if we look at what the S&P has been up to, winging around pretty violently. So on the short-term chart here, obviously we had that massive collapse on the 26th, found lows at around 45.80. Now big support zone, big target area on the downside is 45.5 on the S&P. Didn't manage to get quite as low as that. These are kind of old vol trigger levels. Now we did bounce, and you can see we kind of found resistance where if you look at the volume profile, there's quite a lot of volume traded on the way down, and we found some resistance there up near 46.75, and then overnight we sold off again. I thought that sell-off had something to do with the Moderna comments, saying that a vaccine is going to take a while, and this is definitely, this new variant's the vaccine's going to struggle against it. So that kind of spooked markets again overnight. But the point being that any headlines around the new variant and how effective vaccines are or not against it, and the type of lockdowns and restrictions that we might see coming out of various countries, that is going to be smashing this market around, right? And we know that we've run away from the long gamma zone that we had in the market that was above 4,700. We're now well below that. So it's going to mean that the market's going to be quite easy to shift around, and there's not going to be that support there from the general long gamma positioning that you get in the dealer market, basically, right? So be aware of that. On the downside, I think the next big levels of support, like I say, are 45.50 and 4,500. We should see some support down there if we do see more weakness into the end of the week. According to the guys at Spot Gamma and where they're seeing their kind of volatility landscape. And bear in mind, if anyone has held puts and we get a move from 4,700 down to 4,500, there's going to be some propensity to take profit and unwind some of those hedges, because how often do we get a 200-point move in the S&P that actually holds, right? So there's going to be a motivation for people who own puts to dump them at some point if the market goes down, and that will kind of ease some of the pain and some of the short positioning that dealers are going to be experiencing on the way down there, right? So just things to look out for, but that's kind of what the setup is right now. Obviously, Europe didn't really bounce quite as strongly. So if we bring up the DAX, it's sold off and it's kind of barely bounced, right? Europe's really at the epicenter of the pain right now. Now, ironically, on the back of that, Goldman's, are suggesting that, the euro area is becoming less and less sensitive to restrictions. So they've done a bit of work on this. So COVID restrictions matter less than in the past, right? So what they've done is they've done a scatter plot here, and they've looked at various sort of episodes when COVID has been flaring up, right? Or when restrictions have been put in place. And they're seeing what the GDP shortfall has been relative to 2019 Q4 pre-COVID, basically. And what they're showing you is in Q2 2020, which was early on in the pandemic, there was a lot of economic sensitivity to the restrictions that the government's put in place to try and contain the spread, right? That's the kind of the slope of that bright green scatter plot is showing a lot of sensitivity, right? And then as you've had later episodes and flare-ups of the virus, like the subsequent waves of cases going up, that the slope of that scatter plot has been flattening off, which is basically saying that even when restrictions suddenly go up, which is on the x-axis, the drop-off in GDP as a function of that is not as dramatic, right? And the reasons for that is because the economy has adapted, right? So you've had, change in behaviors, change in the way that people are working remotely, the way people are buying, consumers are spending more online. These type of things mean that the economic impact of restrictions doesn't necessarily, come in quite as hard, right? So I thought that was quite interesting. And I kind of agree that that's a good story over the long term in terms of where we're going to be in 6 months, even if this variant, does break out and we get a lot of cases. touch wood, not too many people die from it and the economic impact will be contained. But that doesn't really tell us what the market's going to do in the next 2 weeks. In terms of macro data, we had strong inflation prints come out of Germany, CPI hitting 6% year on year. Spain had the highest print in 3 decades. China PMIs was fairly strong overnight as well, showing some robustness in the Chinese economy there, despite their restrictions, because they've got this kind of no COVID policy over there. In terms of what's coming up this week, you've got Powell and Yellen. So they're going to probably, do their usual and try and reassure markets. You've got ADP unemployment, ISM manufacturing in the US and the beige book tomorrow. Thursday's a big one with the OPEC meeting, where they're going to decide January production levels. Friday, obviously, you've got non-farm payrolls, which is going to be the main event. All right. But I do think news flow will override any macro data this week. It's all about the headline risk around that, because the market's going to be looking forward now, right? Any data we see this week about, we've got higher jobs number, whatever, is going to get discounted now, because going forward, it matters what's going to happen on this variant. Now let's have a look at commodities. So bring up WTI, probably the most interesting one in terms of action. I mean, what a move, right? So, I mean, I'd flag, what was looking like a risk that if we broke 75, we were going to go down to that 200-day moving average at around 70. I mean, we've even taken that out now, right? So God knows what the kind of chart is saying. You've obviously got the demand side really taking over, right? So obviously people have been focusing a lot on supply and that, but if the COVID variant stops travel around the world, then demand drops off a lot as well. Now, to counter that, OPEC are going to come out on Thursday, and the chances are, they were going to boost output by 400 barrels per day, but if they push back the production increases because of this, then oil could well bounce on this, right? Now, it feels to me, though, that any bounce in oil will probably be short-lived, because the bigger story of the COVID variant is really what's driving oil now. So, yes, they may be able to trigger a little pop back towards 75, but odds are this move might not be done yet. I mean, we've got 62 is a big support area that kind of we saw a couple of times over the year. So that would be an obvious first stop. And then below that, God knows, right? You've got some pretty big levels down towards 50, but if we get there, then it really does mean all hell's breaking loose. Now, as I mentioned before, volatility in oil is up in the 60s now. If you wanted to play a catch the falling knife type trade on oil, the only way to play it, in my view, is call calendars, right? So, the curve's inverted, the front end is 65, the upside's at like 55 in terms of vol. You could probably sell the 78 calls expiring mid-December, and then you buy similar strike or higher in January, and you take the premium down by 50% by selling that front call, basically, right? So that would be a way of you getting long exposure to oil, not really thinking we're going to get ahead much above 75 in the next 2 weeks, but by middle to end of Jan, if we're back above 80, you're going to be on a winner there, basically, right? So I think that's the way to catch the falling knife, if that's the trade you're looking to do, because you think this is all overdone. Goldman's put out a piece saying that they think this is massively overdone. They think fair value after this news is 80 on oil, and we're trading like sub 70, right? So if you buy into their analysis and you agree with them, then those sort of call calendars on oil look good. I haven't done any myself yet, because I'm just not so sure about, that trade yet. But when I do decide to buy it, that will probably be the look and feel of what I decide. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.